Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
My name's Mark McEvely. I am the Chief Investment Officer here at Jessup Wealth Management, and just wanted to thank you all for taking time out of your busy days to join me for this March Market Update webinar. There is obviously a lot going on in the markets and the economy today, so there is no shortage of things to talk about, but I am going to try to do my best and keep my presentation to no longer than 20 minutes in length. With that said, let's go ahead and get started. So like always, we're going to start with an updated daily chart of the S&P 500, which is the main stock market index in the U.S. over the past year. And, I'm sure that most of you have heard that it has been quite a shaky start for stocks through the first couple months of 2025. And similar to his first term in office, President Trump has been using tariffs as a bargaining chip with other countries. So far, it's been more bark than bite, with the new administration delaying tariffs on Mexico and Canada. And literally just 10 minutes ago, I just got an alert from the Wall Street Journal that said that Trump is going to be raising tariffs on Canada for steel and aluminum to 50%. So this is always ever changing, right? But we saw this during his first term. There were several new tariff announcements and scary news headlines, but stocks ended up doing pretty well during President Trump's first term in office. So we do want to keep our focus on the long term instead of the short term media headlines that we're seeing right now. And what's interesting about this chart to me, though, is that the S&P 500 recently broke down below its 200-day moving average, which is represented by the red line in the chart on the screen right now. And the 200-day moving average is used as a popular metric to determine how well a stock or an index is doing. So if it's above its 200-day moving average, you can generally say that the index or the stock is in an uptrend. And if it's below its 200-day moving average, you can generally say that the index or stock is in a downtrend. So in my opinion, the next few days are going to be very telling on which direction the market goes from here. So right now, obviously we're just below that 200-day moving average. However, once indices and stocks reach their 200-day moving average, it's pretty common for the stock price or the index price to chop around that level for quite some time before picking which direction it wants to go. So I do think, like I said earlier, the next few days will be pretty critical in determining which way we go from here over the next 3 to 6 months. But kind of moving on to our market outlook for 2025, and we think that the next 6 to 10 months is relatively positive. And I know it might be hard to see that with everything that's been going on in the stock market over the past couple weeks, but we do think that eventually, solid economic growth, strong earnings, and disinflation which means the rate of inflation is slowing down, will move stocks modestly higher this year with more volatility or more ups and downs than we saw in 2024. And obviously what's going on in the first quarter right now is a good example of that. But I do want to briefly discuss a couple market indicators that we look at each year that may foreshadow how the rest of the year will unfold. So I'm going to start in the bottom left-hand side of the screen. So the saying in our industry is, as goes January, so goes the year. Meaning that if January is positive for the S&P 500, then the rest of the year tends to finish positive as well. And some stats to back that up for you all is that since 1950, when the S&P 500 finishes positive for the month of January, the index finishes the year higher 86% of the time, and average returns are about 12.2%. In addition, top right-hand side of your screen now, as silly as it may sound, we also do look at the performance of the S&P 500 during just the first 5 trading days of the new year. And again, since 1950, when the S&P 500 was positive during the first 5 trading days of the new year, the full year finished higher a little over 81% of the time for an average gain of a little over 14% for the year. So in 2025, both January and the first 5 trading days of January were positive. So we do have data on our side going through to the rest of the year. Now, obviously, that doesn't mean it's a foregone conclusion that we're going to end the year positive. We just have history on our side. And again, we always like to say that history in the markets never repeats, but it always rhymes. So things that tend to happen in the past do sometimes happen in the future as well. And that's what I was trying to get at with the stats that I just presented to you all. So kind of sticking on a similar theme, if you look back at the history, of presidential cycles, post-election years tend to be pretty average for stocks. So it wouldn't surprise us if the S&P 500 was up somewhere between 7 and 12% for the year. And as you can see in the chart on the screen, it is relatively normal for stocks to experience weakness in the first quarter of a post-election year. And in fact, Q1 of a post-election year is the second weakest quarter out of the entire 4-year presidential cycle. So that just goes to show you that more often than not, again, the first quarter is relatively weak the year after the election. So what you see on the screen is the blue line shows the average S&P 500 performance during post-election years going back to 1950. So you can see that it's up right around on average that 8% range since 1950. And then the red line is the performance of the S&P 500 so far in 2025, or just as of the end of February. And historically, stocks tend to bottom in early March before kind of getting their act together for the next several months. So again, this isn't another foregone conclusion, obviously, but if we do use history as our guide, the probability of stocks moving higher from here is there. Next, kind of on to wrap up the current market outlook for 2025, there are a lot of people out there right now saying that this sell-off in stocks is the beginning of a longer term downtrend. However, if the bull market ended today, it would be the third shortest bull market since 1949. And this bull market's length, this bull market that we're in right now, the length of that has only been 873 calendar days, and this data was as of March 3rd, so last week. And the average length of bull markets have been a little over 1,900 trading days. So again, this would be a pretty short bull market if it ended sometime over the next couple of months. So I do think the probability is low that this is the end of this current bull market. It obviously could be, and we could keep falling from here, but the data says that it's not quite likely. I think it is important to pull out that this chart on the screen, 1966 to 1968 only had 784 calendar days in that bull market. 1970 to 1973 only had 961 calendar days in that bull market. So there is precedent for that, but as you can see, that red line on the graph of just over 1900 days is the average, and so we still have quite a lot of room to go to reach that average. Not saying it has to reach the average, but I think it just helps kind of put things in perspective on where we are today. So moving on to a couple more charts that we usually review. We've reviewed these the the next three slides in previous market updates, but I do think they are important enough to keep revisiting them a few times per year. And this is one of my favorite charts of all time because investing can seem scary at sometimes, like it does right now with everything that's going on. But I think this chart does an excellent job explaining why it's important to stay invested in stocks over the long term and to have a long-term market outlook. So this chart shows several negative events from the early 1900s up until 2024, and I'm sure many of you, myself included, would have thought that these negative events would have derailed stocks for good. However, the market, kind of took them in stride, and stocks kept moving higher over the long run. And this is why it's extremely important to stay focused on the long term instead of the day to day and week to week fluctuations in the market. And I know how difficult this can be, but that's why we construct a plan and stick to it during those tough times. This next slide shows the years in which the S&P 500 had a return above 20%, and this was through the year 2023. And these great years usually do not come without some sort of volatility. So in order to achieve these high rates of returns, investors must endure volatility along the way. And another saying in our industry is, volatility is the price you pay for returns that average above the risk-free rate of the term. And when I say risk-free rate of return, I'm talking about the return you could get on a short-term U.S. Treasury bill. So in this chart, the first column is the year, obviously. The second column is the return for the S&P 500 in that corresponding year. And the third column is the maximum drawdown from the high point during the year to the low point during the year. And as you can see, some of the best years in the market have come with significant bouts of selling and volatility. So, for example, in 1982, the market finished up over 20% for the year, but that wasn't before, it had a 16%, over 16% pullback at some point in time. Again, 1998, S&P 500 finished the year up 28%, but at some point throughout the year, it had a 19% pullback. So, I know what we're going through in the market right now is not easy, and sometimes the hardest thing to do is sit on your hands during times like these. But again, using history and using data, it does show us that this is not uncommon, if that makes sense. Next slide is, one of my favorites that we talk about with clients and investors. And just like most things in life, investing isn't easy, and stocks do not go straight up. So there are going to be dips and challenges along the way. But if you have a long-term outlook and a game plan put together, it does increase the probability of reaching your goals. So I think that there's this misconception among some investors that the stock market has to give you know 7% per year. And while that's between 7 and 8% has been the long-term average, the market rarely actually returns between 7 and 8% per year. Some years it's going to be up 20%, up 15%, up 12%, up 30%. But then some years it's going to be up 2%, down 3%, down 15%. So very rarely does a year end within that 7 to 8% range, and typically returns are very lumpy. So I do think that this graphic does a good job of explaining that.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of The Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.